Hi, I'm Lisa Sarajian, Analytical Manager within S&P's Corporate Ratings Department. Welcome to Credit Matters TV. We recently sent a team of analysts to the annual ICSC convention in Las Vegas for an on-the-ground assessment of the leasing trends that are currently impacting retailers and their landlords. We published an article exploring our takeaways from the trip, and joining me here today are two of the authors of that report, Beth Campbell, a seasoned senior analyst who covers many of the retail REITs that we rate, and Anna Lai, a veteran senior analyst within S&P's retail team. Ladies, thanks for being here today.
Thanks.
Thank you.
Beth, let's start with you. We've got a stable outlook on retail REITs with a positive bias, but a negative outlook on retailers. Can you explain why that difference is occurring?
Sure, Lisa. The REIT group does not disagree with the retail analyst's assessment that prospects for retailers are perhaps cloudy because of macroeconomic conditions such as weak job growth, volatile gas prices, things that could undercut consumer spending. However, we also see there are some supports for our stable view of the retail landlords. So I'll walk through a couple of those. First of all, the retail REITs tend to have just stronger, higher quality portfolios relative to the market average. So for example, better demographics, more infill located properties, they tended to outperform during the downturn. And what we see today, for example, is that our rated retail REIT universe, the occupancy in their portfolios is about 93%, which is higher than the national average of 87%. So we have better quality portfolios. The second thing we've seen, because of these better quality portfolios, they're able to attract tenants, higher occupancy, and what we've seen is a real benefit from sort of the barbell of the retailers. So Simon, General Growth, sort of the mall companies are benefiting at the luxury end from strength in that consumer. And then our power center and strip center landlords are benefiting from strength in the value-oriented retailers such as Target and TJ Maxx. What we're also seeing, factory outlet centers actually saw occupancy and rent growth even during the downturn. They really had both ends of that barbell offering luxury products at a value price. And then maybe the third point, I would say the support for our stable outlook and slightly positive bias on the retail landlords that we rate is just the limited new supply. So what we're seeing is just gradual recovery in demand. In fact, what we heard from the retail landlords we met with at ICSC was this is their strongest leasing season since 2008. So overall we're really expecting the sector to continue a modest recovery in occupancy and rents this year.
Okay, great. Let's talk a little bit more about the difference between luxury and value. Anna, what's driving the growth at the two ends of the spectrum?
Sure. Thanks, Lisa. So in terms of the luxury, so that the extremes of the spectrum, if you will, the luxury and the value segment, those two segments have certainly outperformed the general retail industry. And the strength in the luxury sector is mainly due to the recovery in the capital markets. With the stock market recovery, the upscale consumer are certainly feeling better about themselves, about the wealth, so they are outspending again after retrenching during the downturn. So we see sales trends at Neiman Marcus, Saks, and Nordstrom really outperforming other retail formats while also achieving more full price selling. So that in terms of sales growth and margin trends, they are trending much better than on other sectors. Now on the other extreme, the value segment, I think the state of the general economy certainly helped this sector with unemployment still high, weak housing market, and a sluggish recovery. Consumers are very value conscious and they try to stretch the budget, so they will trade down to the value concepts, including the discounters, dollar stores. So we've seen really strong sales trends In the extreme value segment, such as the dollar stores, we rate both Dollar General and Family Dollar, who are the largest chain in this segment. They benefited from this trend and has achieved sales trends in the mid to high single-digit levels. The discounters, such as Walmart and Target, are also benefiting from this trend, and we've seen their sales recovery in the low to mid single-digit levels. So we'll continue to see these two extremes of the retail spectrum to continue to do well in 2012.
And are the retailers at the luxury and value end also expanding store count, or just benefiting from?
More on the value end,
Okay.
I would say, because I think the department stores, the luxury department stores, are relatively mature. We haven't seen a lot of sales growth, and they're not planning a lot of sales growth in terms of new stores. But the value concepts are growing, and it is one of the few sectors that are seeing growth. The dollar stores are growing their store base significantly. I think between 5 to 7% of the square footage per year. Family Dollar and Dollar General are planning to put up together over 1,000 stores this year.
Okay. Beth, you touched on the supports to retail REITs, the quality of their portfolios and the limited new supply. What are some of the risks that they face as landlords?
Sure, Lisa. Maybe there are three key challenges we see right now, and we kind of touch upon them in our report. The other things I'll talk about are the small shop space. So other than maybe the Dollar Generals and a handful of others, some burger concepts, et cetera, we're really not seeing a lot of growth in the small shop space. What we've seen is the demand is really coming from the national retailers, so the anchor spaces in the retail REIT portfolios are pretty full. You're seeing occupancies 95% and higher in some cases. But the occupancy in the inline space is about 10 percentage points below that. Now the good news is we're seeing less bankruptcies, less store closings in those small shop tenants. But because of the weak economy and limited financing for those entrepreneurs, we're really not seeing robust growth either. We wouldn't expect to see that improve likely until the economy really picks up a little bit. So that's one challenge, is the small shop. The other is some national retailers are shrinking their footprints. One example is Best Buy. So they've had challenges with e-commerce, online competition. They're rethinking, what their store size should be from a profitability perspective. The good news is we think our retail REITs generally, the configuration of their stores, they have a lot of stores that were built in sort of the mid-90s, late 90s era. They are well configured to be able to cut those up into smaller spaces with the space they get back. However, there's a cost associated with that, and ultimately it is reducing demand and increasing supply. But we do still believe that it's better to keep a tenant even in a smaller footprint than to lose that tenant completely. So we talked about small shop, we talked about stores that are shrinking. The third is the REITs that have exposure to some of the weaker department stores, the Sears, the JCPenney's. One silver lining to that cloud for those REITs that have maybe better positioned malls, if they get that space back, they could actually redevelop it and ultimately longer term perhaps improve the overall quality of their tenancy and of their portfolio.
I guess on that note, Anna, what's our latest view on JCPenney's, Sears, and Kmart?
Sure. Those three names are certainly underperformers relative to their peers. I'll start with JCPenney. We recently lowered the rating on JCPenney, and that's after a very weak first quarter, certainly much lower than our expectations. So I think their strategy to change the merchandising and pricing at the same time is proving to be difficult to implement. I think that we're going to continue to see some sales weakness this year as they try to get the message across to the consumers, and so potentially there could be further sales and margin weakness as the sales trends will remain weak. In terms of Sears, they've struggled for many years, and the acceleration of the decline picked up last year, so things really got a lot worse than what we'd expected. So we lowered the ratings on Sears also earlier this year. Although they do have new leadership, a new CEO and chief merchant, We don't see any significant change yet in their merchandising strategy that will give us confidence that the recovery is underway. So we maintain a negative outlook on the ratings at the CCC+ level. So it remains to be seen whether they will be able to achieve a recovery in sales. But their poor merchandising strategy and their lack of investment in the stores has really led to this state of the department store Sears. In terms of Kmart, they're also an underperformer relative to Walmart and Target. In fact, they are a very distant third player because the profitability is much lower than Walmart and Target, who are high investment grade discounters. So it is sort of the same issue as Sears. The merchandising and the lack of investment in the stores has really deteriorated the company over the years. So it remains to be seen whether the new leadership could turn around this business.
So thanks very much for joining today.
Thank you.
And thanks for joining us. That's it for now.